Welcome everyone. Thanks for joining, and we're about to get started. I'm Carmen McKinney and I'm the Chief Operating Officer at Ibis World, and today we'll be joined by Jocelyn Phillips. She runs one of our business units here in New York, and Rob Miles, our Senior Analyst. We're going to focus on economic performance in the face of trade winds, and also how Ibis World actually applies this information in the current economic climate. Rob and Jocelyn will go through this perspective based on the evolution of trade, and then we're going to follow up with a short discussion after they're done. At Ibis World, we provide busy professionals with a quick overview and key points of specific industries. We save them time and resources of not having to do it themselves, and today is a great example how you can apply that information to the day-to-day decisions that you make. With that in mind, I'd like to express that we use our information just like our clients do. And I think that's really important to explain to you guys the real application of what Ibis World does. Take it away, Rob.
Thanks, Carmen. So let's get started by looking at some of the trailing quarter headlines. So what we have are just a snapshot of the economy as we see it right now. So real GDP was up 4.2% last quarter. The unemployment rate was low. It's been dropping lower and lower. Earnings have been up, consumption has been up. We actually saw non-residential fixed investment increasing. Exports were actually up last quarter. But we did see a decline in residential fixed investment. And that's something that we're tracking very closely here at Ibis World as we go through our industry analysis. So what's been the story of GDP? If we look at GDP and its components, a major overlying trend has been rapid increase in private domestic investment. So this is after the election, and as we saw tax reform go into effect, you've seen a lot of increases in investment from the business side. So what we've been seeing overall is strong positive growth. And in the last quarter, we did see consumption expenditures pushing off relatively strongly.
So Rob, like you mentioned, GDP growth is obviously, it's a good thing. GDP indicates overall economic output and consumption. So when we see growth in GDP, we're going to see growth across most things that are good for most businesses. But specifically when we see CapEx rising, this facilitates demand for all manner of things that touch a really wide variety of businesses. So everything from personal consumption on the consumer goods and retail side, which will have upstream effects in the marketing industries, as well as commercial loans, credit purchases. So the increase in CapEx in conjunction with the tax reform is also going to require scrutiny from accountants. I guess what I'm getting at is just that when we see GDP and CapEx increasing, we're going to see growth across all aspects of the economy. It's going to affect your business no matter what you do.
Exactly. So we've spoken a lot about investment up to this point, and a real key component of investment is spending on construction. So what we have here is total construction, residential construction, and non-residential construction. And when we look at construction at Ibis World, we really see it as a conduit in between all the different industries. What connects all the different industries from mining to manufacturing, all the way down to retail increasing or decreasing, people spending and building more stores. So if we look at this chart, we can see the recessionary period. There's sort of a precursor with residential spending dropping, and the slow recovery in both non-residential and residential. And that's something that's really been driving growth in the last 5 years or so. And it's something that's been evolving as we look into the current period. So a key component of when we're tracking construction spending is new housing starts. So if we look at starts and permits, we can see that there's been upward trajectory over the last year or so, but we are starting to see some slowdowns in terms of the moving average. And it's something that we're tracking very closely, as housing starts tend to be a precursor for weakness in other areas of the economy. So if we pin down into residential trends, we can look at how rising costs have flown over the last 5 years. So things that are pushing down growth in housing starts. We see the mortgage rate increasing over the last year or so. We've also seen prices of new homes increasing. These are all things that are weighing down on growth in the housing market. So to move forward, let's go with housing starts over the last couple cycles, right? So over the last 60 years or so, we can track how housing starts have moved. And if we overlay recession periods with this, we're able to see that it tends to be a precursor that formulates prior to recession. So over the last period, we have seen slow uptick in construction spending on the housing market, and that's something that's really driving growth, and it's indicative of a lot of trends, but it hasn't had this broad upswing that we've seen in other periods. So it's something that as we're seeing interest rates rise and other factors causing slowdowns in housing, we're not necessarily as worried as before in terms of a sharp downturn.
Yep. I think, again, what's interesting here is that even though things are slowing down in the housing market specifically, like you mentioned, nothing exists in isolation. So the housing market might be cooling, but capital formation in non-residential assets is still rising. So developers are just going to change their focus. They're going to demand different kinds of loans. So even a cooling like we've seen in housing starts across the board doesn't necessarily mean that we're talking about a bad business environment for any business that's operating. It really is it's just gonna be a change in direction as opposed to a change in overall trend.
So what we've been talking about so far have been trends and recent growth patterns. And that's something that we look at very granularly here at IBISWorld. So we have our business environment database where we track over 400 different drivers of external growth, right? So what we have on the screen are some of the more specific ones that we want to touch on right now, things that have been driving the steady growth we've seen across industries over the last 5 years. And we can touch on what we're expecting to happen in the next 5 years, in the next year or so. So what we can see here is that the trade weighted index, we actually saw upward movement in the value of the dollar. And this has actually had a negative effect on a lot of different industries. It's something that has been hurting our manufacturing industries to a certain extent. We also saw the value of non-residential construction is increasing pretty strongly in 2018, something we're seeing help downstream industries looking at mining, oil and gas, manufacturing. We can also see what's happening in a slowdown in residential construction. We're still seeing positive growth here, so it's something that's helping industries in 2018, but we're not really seeing the strong growth that we saw over the 5-year period. And finally, I want to touch on something that's more of a proxy driver that we use a lot here at IBISWorld. So the percentage of services conducted online is exactly what it sounds like. It's the amount of services conducted online. What this really helps us track is where technology is moving and how industries are evolving. So it's in red here despite having growth, and what it actually tends to do to industries that we track here is that as people turn to mobile services, online purchases, it's really negatively affects a lot of different industries. It's something we're seeing form a lot of issues, especially in retail. Everyone's probably been tracking a lot of issues in retail. You saw a lot of issues in terms of bankruptcies earlier this year, and it's something that's really part and parcel of people moving online and moving away from brick and mortar.
And tracking drivers like this, I think, is key to understanding economic performance of a national economy as well as an individual business's economy, not to forget the economy of an entire industry as well. You look at something like percentage of services conducted online that you just highlighted, and as you pointed out, this is something we've seen strong growth over the past 5 years, and we expect more strong growth over the next 5 years. That can be a good or a bad thing depending on how your individual business is situated within the economy or within an industry. We at IBISWorld track these drivers historically and also project them out forward because we've learned from our own business that knowing how these drivers have moved in the past helps us make decisions about what to do in the future. And I think given the breadth of drivers shown even in just this slide, any business can make decisions the same way, looking at the variables most relevant to them.
So now that we've looked at some of the drivers, things that are really the underscoring change in industries and the overall economy that we study, we're going to pull back and look at some sector snapshots. So why we look at sectors, they're the aggregate of industries, right? We cover around 700 industries, and these sectors account for the aggregate of each of those individuals. So when we look at how sectors are performing, they really give you a sense of how large, broader trends are really affecting the economy. So if we look at over the last 5 years compared to 2018, we saw a lot of issues with commodity prices. If you remember back to the previous slide, the price of oil was down over the last 5 years. It's something that really affected a lot of production sectors. You get mining and you look at manufacturing. As prices go down in oil, it tends to correlate relatively strongly with a lot of other commodity prices, which really drags down mining and it funnels into the manufacturing sector. What you're also seeing is how volatility can occur at the sector level. So despite problems over the last 5 years, mining has actually jumped very rapidly in 2018, and that's almost entirely explainable through commodity price increases. Something directly relates to revenue for these operators in those industries in the sector. The manufacturing level, you see a similar type of trend. It occurs in construction as well. So as these types of industries in those sectors gain momentum and begin to grow, that's when you see construction sort of connect in between the two. So moving into mining specifically, what we can see here is when we parcel out the mining sector, we can see that it's driven primarily by price drivers. So over here on the left-hand screen, we can see all the drivers that forward into mining, and that's how we see external pressure pushing mining in one direction or the other. And when we look at mining, how it's broken down in its constitutive industries, we can see that oil drilling and oil and gas field services really account for the lion's share of mining, right? In terms of revenue, it's by far the largest segment. And then we can trickle down into other parts of the sector and see coal mining, sand and gravel mining. Different industries sort of fill out the mining sector, but it's really progressed forward by the one large area of it, which is oil and gas. So if we move on to construction, we can see a similar breakdown of how we look at construction. It's driven by interest rates, it's driven by overall construction, it's driven by corporate profit, it's driven by government spending. And when we look at how it's broken down at the industry level, it's much less weighted towards one industry than when we look at mining. So you can see commercial construction, you can see electricians, and you can see housing developers, all sort of forming the overall aggregate of the construction sector. So it's much less weighted towards oil and gas. We are seeing a large amount is pushed towards business, commercial type construction. But you do see the dichotomy here. We can see large producers, we can also see electricians. Electricians account for a huge amount of revenue in the US, and it's also primarily made up of small individual operators. So you can see how the construction sector is broad, it's huge, and it's a main driving force. It's a conduit for other industries in the economy, but it's very widespread across different types of industries. And then finally, we can move on to manufacturing. Once again, it's sort of looking at an aggregate of drivers that we see for mining and construction. You see trade-weighted index, so trade is huge for manufacturing. When we study the industry level in manufacturing, we always study trade for manufacturing industries, and that's where a lot of our analysis goes. We also look at commodity price as a key driver for manufacturing. That's because you see things like petroleum refining, which is the largest industry in the manufacturing sector. So it's sort of this connection between mining and manufacturing. You see how it's all sort of connects together as you look at the sector by sector level. The more granular industries really demonstrate the connections between the different sectors. Then in the US, we have many different types of manufacturing that account for a large share of what we produce. So you see things like meat, beef, and poultry, not necessarily hamburgers, but everything, right? So everything that's processed once it comes from the farm. Then we also see a lot of value-added manufacturing. See, these are aircraft parts, SUV and light trucks, and brand name pharmaceuticals. These are things that really drive manufacturing in the US. Our ability to produce value-added goods. So you can see SUV and light truck manufacturing, a huge amount of revenue from a small amount of operators, right? Only 71 operators producing different types of trucks. And that's something that we can sort of see how manufacturing operates differently than other types of sectors. And so what the point we're trying to get to by going through sector by sector information is that no industry operates in isolation. That's a key component of what we do here at IBISWorld. Each industry has its own individual supply chain that connects it to other types of industries. And you can see that everything is connected. So if you're a commercial building construction, you buy from iron and steel manufacturers, but you also help build a factory that builds iron and steel, right? If you're an oil and gas extraction operator, you use commercial building construction to build out your oil field, your drills and whatnot. And you also sell to petroleum refining. But even at a more granular level, you can see that underneath each of these industries, we have the key drivers that push that industry in one direction or another. You can see similarities between these. So not only do we see connections at the supply chain level, we also see connections at what drives these industries, which really forces home the idea of no industry operating in isolation.
Yeah, I think that's really the big takeaway here is that to understand how your business is going to operate within its environment, you need to understand the connections between various sectors, various industries, and the fact that they all share drivers, they share demand, and they share operating environments. So to understand, even going back to the examples you brought up earlier of mining versus construction, the fact that a sector like mining can be so much more dominated by a few industries, whereas construction is a lot more fragmented. If you're operating in a space that is either within one of those sectors or heavily dependent on one of those sectors, understanding the difference between that operating environment is going to make a big difference to how you make business decisions. And that's really key, like you said, Rob, to what we do here at IBISWorld. To get a little deeper on this, I'd recommend that anybody out there who's interested tune into our next webinar, which is going to be on November 14th. We're going to focus more on concentration risk in that. We'll get a little bit more context around the latent correlations that build this environment than we can really get into today. If you are interested in that level of detail, I'd also recommend our first webinar from a couple weeks ago. It's called Flying Blind, and it's available on our website as well.
Thanks, Jocelyn. So we could probably sit here and talk about no industry operating in isolation for like an hour or so, but everyone also wants to hear about trade. It's the thing that keeps us up at night and also makes us wake up early in the morning, scrolling through Twitter, trying to see what happened last night, what's happening at 5 in the morning. So what we have here is just a brief little timeline, a snapshot of what's happened so far this year. We could spend a long time discussing them each specifically, but we're going to look at a broad picture just to give you a sense of what we're tracking here at IBISWorld, and something that we're constantly writing about on the Industry Insider to give you a forward-looking perspective on that. So the first thing we saw this year was a washing machine tariff. So it's a direct tariff on washing machines coming into the U.S. And we see the steel and aluminum tariffs. These are that Section 232 national security basis tariffs, something that's sort of propagated a lot of the other trade negotiations that happened in 2018. So now we're going to start going through the quick timeline with China. So we see China tariff on $3 billion of U.S. goods, see an additional levy. We're looking at the U.S. responding with $50 billion on China, a further institution of tariffs by the U.S., further instigation of tariffs by the U.S., and then we're looking at China retaliatory tariffs, and finally the last sort of component we saw last month from the administration pushing further tariffs on China. So what we're seeing with the U.S.-China relationship is that if we look at a product level, we're approaching 100% of all products, right? China has fewer products that they buy from the U.S., so they're more close to 100% at this point, but the U.S. is also rapidly approaching the maximum threshold that you can apply tariffs to. So we've seen a very rapid uptick in trade issues with China, and something we're studying very closely, but it's also something that's ongoing, and we have to update our information every day, looking at the news, looking at the recent stuff from the USTR and what's happening. On a separate timeline, we can look at how different countries have responded to the steel and aluminum tariffs. So you have Mexico tariffs coming in June, EU tariffs coming in June, Canada has retaliatory tariffs in July, and then 2 months ago, we did see the formation of a trade deal with Mexico. And then on the 11th hour of one of the several deadlines that was put on the new NAFTA negotiations, we do see the USMCA come out. That's something that's very nascent in our ability to study it. There hasn't been a huge shift. So with USMCA, it does adjust how we deal with the automotive sector in the NAFTA zone, or in the USMCA zone, as we'll start calling it, I guess, if everything goes according to plan. But it's really something that isn't a huge broad shift in what we're seeing previously with NAFTA, but there are changes that are going to be ongoing, and the effects will be known after things get passed in the coming months. So to look at what's really forming our analysis of what's happening in the trade areas is the trade deficit, right? It's something that's a huge talking point from the administration. And what we saw is, as you look at the value of the dollar movement, and you do see a broadening of the trade-weighted index and the trade deficit increasing. And something we also saw in more recent years as the dollar value shot up again. So as we touched on when we looked at drivers earlier, as you saw an increase in the value of the dollar, this has actually been hurting manufacturers, and something that weighs on our trade-weighted index measures. So as we look at that, it's something that's really driving the force of the administration to argue for tariffs against other nations. So what have we seen in the last 20 years or so? If we look at this chart, what becomes obvious is we've had the same basic trading partners over the last 20 years, but there's been a rapid increase in imports from China. And it's something that's really sort of underscored the argument to increase our tariffs against China. And it's really something that, as we study the relationship between the U.S. and China moving forward, it's become imperative that we understand exactly what's happening at the industry level, which is why we've come out with Excel tools and we constantly create new industry, forward-looking content to sort of analyze what's happening between the U.S. and China at the industry level.
I think from an economic perspective, looking at this chart, a thing that comes to mind right away is the trade deficit, like you mentioned, Rob, and I think when you are reading the news about how what's going on in trade right now is going to impact the business environment in the United States, deficit's one of the first things you hear about. People are justifiably interested in what might happen as a result of this trend. There are more issues than just the deficit at stake here, though. There are things like intellectual property rights come into play. There are a variety of different issues that come up while we see China and the U.S. specifically as an example entering into the same markets and the same manufacturing spaces. When you think about these issues in the context of how important value-added manufacturing is to the United States, a whole host of new questions come up, especially depending on your specific business, your specific industry, where you stand, and how you sort of fit into the supply chain. And to understand how these issues are going to impact your environment specifically, you need to know where we've been in the past and how similar issues like this in the past have impacted businesses going forward. I think that's what a lot of this data, that's where a lot of the value in this data can really come from.
So exactly, looking at the past is exactly what we're going to do right now, and look at how that washing machine tariff, the first part of our timeline, has actually been funneled through, and we can look at how that's affected trade. So if we look at back in 2016, we did see a sharp drop-off. This is when we first saw anti-dumping duties levied against China. So you can see an immediate drop-off in washing machine imports. And then following that, we can see a movement in to different areas. So as China was, duties were levied against China, we see a movement to Southeast Asia and a rapid increase in washing machine imports from Southeast Asia. And then in early 2018, we see the tariff levied against all imports of washing machines. And what we do see is a drop-off in imports and a sharp increase in washing machine costs. So when you think of washing machine costs, you think of what's in your house, what's in your apartment, and it directly affects how people are costing and building out what they're doing in terms of building developments and pricing out, think your rental apartment with its own washer and dryer unit. It makes everything much more expensive. So what we can do with that is look at steel trends. So into 2018, we saw steel exports sharp drop off after June when we see the tariff go into effect. We see imports also have a sharp drop off after June. And if we look at how shipments have gone, we did see an uptick prior to the tariff levy, but it is something that we saw growth prior to that. So you're seeing people buying up steel, selling steel before tariffs go into effect. And what this has meant for consumers and buyers of steel is prices have been moving up. So if you look at everything, all those key value-added industries that we tracked in the manufacturing sector, these increases in steel prices are all being pushed into those industries and affecting those industries. What we're going to see over the next few months or so is we're not really sure, but as these trends are moving forward, we're going to have to look at the past with washing machines and look towards steel trends in the future. So now we're going to go through a discussion with Carmen and Jocelyn about how IBISWorld is responding to the changing economy.
Well, thanks, Rob. That was really digestible, and I think that's one strength that IBISWorld has is we find ways to make really complex issues really relevant. And I think an important factor is that we use our information for our own business decisions. So a key part that we're trying to do with these webinars and this series of webinars is actually teach our clients and our listeners today how to use our information to make it applicable. Because ultimately, our concerns are also our prospect and client concerns because we're all businesses. We sell to businesses, and all of this affects us in one way or another. So understanding it is the most important thing to make educated decisions. A big thing that affects our business is really CapEx. If companies aren't feeling confident to spend, that really hurts us, but we do use our own information to find opportunities and find where that confidence is. So I really appreciate you going through that, Rob, and Jocelyn as well, to make it really digestible for our audience.
Yeah, and at the, I think an interesting point here is that this decision-making process can happen no matter what your business looks like. I probably belabor that at this point, but I'm just thinking, Carmen, about what you spoke about. You're looking at CapEx and you're thinking about decisions that we need to make for the broader business. In my day-to-day role, I'm running a sales team that's on the phone, trying to connect with people, trying to get information in the right hands. They need to understand other aspects of what's going on in the economy, what the sort of conditions that the people on the other ends of the phones that they're on are facing. I need to understand the labor market and what hiring decisions might look like in the next few months. So no matter what your business is, big, small, where it's located, more information is a good thing. And I think that's, to echo what you've said, Carmen, a strength of what we do here at IBISWorld is gather all that information and make it usable to anybody from the front lines to decision makers at a big business. Great. Well, with that, we're going to go ahead and wrap up for today. I want to thank everybody for joining us. Keep an eye out for a thank you email you'll get from IBISWorld with a link where you'll be able to download the recording of the presentation today. The presentation will also be made available on our website, which you can see on the slide that's up on your screen now. If you're interested in learning more about IBISWorld or would like to schedule a demonstration of any of our products or content, you can visit our Industry Insider, which again is that URL up on the screen right now. And we would love to have you all join us also on November 14th for that next webinar I mentioned. That'll be hosted by our chief economist, Rick Wazinski, and it'll be focusing on concentration risk specifically, so you can register for that on our website as well. Thanks, Carmen and Rob, and thanks to everyone else out there, and hope you all have a good day.
Thank you.